The ports are shut down on the eastern seaboard and in the Gulf of Mexico. The war in the Middle East is heating up, and China floods their markets with liquidity. We're going to break down what this means to investors on this episode of Investment Insights. Thanks for tuning in to this episode of Investment Insights from Opal Capital. My name is Jay Coulter. Joining me as always, Adam Mueller and Austin Graff. We're going to start off with our chart of the week. The Fed's mandate is to promote maximum employment and maintain price stability. Today, unemployment's at 4.2% and CPI is under 3 and dropping. So why did the Fed lower rates at their most recent meeting? Look at this chart of the S&P 500. It's up 35% and GDP is growing close to 3%. In my opinion, it was too soon unless they see something that the markets don't. Austin, what are your thoughts?
I think it's an interesting observation, and really there's kind of two ways of thinking about this. The first thing is you could say the market has done an amazing job at picking up on the Fed's forward guidance. And so all of these rate reductions have already been factored in to both the interest rate and the equity markets. The second kind of approach would be that the Fed's actually being bullied around by markets because they're too afraid to actually not come through on the rate reductions that have been communicated to date, even though the economic data isn't indicating that a rate reduction is required. And so I think it's actually somewhere in the middle. From an actions perspective, I would say that investors should consider the market to continue to go higher as long as the Fed continues to have an easing stance outside of some type of exogenous event, which obviously would be bad for markets.
Adam, what are your thoughts?
Yeah, I think this is a classic case of the tail wagging the dog, which Austin alluded to, I think, in the second half of his comments there. And it feels like the Fed is reacting to markets instead of trying to get ahead of things. It feels like it's a situation where since they hadn't made a move in a long time, they felt compelled to for some reason. And they were more concerned with markets freaking out if they didn't do something than actually thinking about what's the right thing to do. And, it is an election year. There's a lot of geopolitical things going on. So, it's unclear. It's unclear to me how independent this Fed is, not necessarily from political pressure per se, but from market pressure.
Let's move on to our first topic for this week, and that is the port closures along the eastern seaboard and in the Gulf of Mexico. Adam, what do investors need to be thinking about as it relates to these closures?
Look, I think the way to think about this is in the short term, it's probably not a big deal. But if it drags on, it could become a huge problem, and it could be inflationary, and it could make the Fed wish they hadn't cut by 50 basis points. We're a service and goods based economy, and we need our bananas, and bananas being a proxy for everything that's coming in through these ports, let's say. And it's a real problem if goods can't get to the U.S. We just a few years ago we lived through supply chain issues, and we saw how that contributed to a lot of complexity in the supply chain and inflation in markets, and we don't want it to be deja vu all over again.
Austin, what's your take?
Yeah, it looks like the longshoremen are actually taking a very aggressive stance here. If you've listened to some of the rhetoric, they're looking for a lot, and I wouldn't expect this to end anytime soon. It's definitely becoming a political event, even though price increases are likely not to be experienced until the elections already happened. Just the fear of these price increases are likely to impact the election. If it does go on longer than expected, we should expect to see some pretty dramatic price increases for Adams bananas and also car parts, which are some of the main elements that come through these particular ports.
What else comes through these ports? You see on TV the runs at Costco. We see it at the grocery store. People amazingly hoarding toilet paper again, like they did 4 years ago. What do we look out for from an investing perspective of what might become in short supply?
It's actually pretty interesting because, call it 4 or 5 years ago, the bulk of products came through West Coast ports, and then there were some West Coast issues. So we've seen more and more flow through the East Coast and Gulf ports. But some of the bigger things that come through it's a pretty significant hub for auto imports and auto parts. But basically anything that you buy that's imported could be impacted by these port closures. And when it comes to what consumers buy, almost everything's imported at this point, which is why we're seeing some of the views on tariffs and whatnot with some counterparties.
Next topic. The war in the Middle East is getting hotter. There are obvious humanitarian concerns for the region, but Adam, what do investors need to think about as this war starts to heat up?
Oh, what? It's a great question. Look, I think obviously you see some volatility in oil prices, but the reality is the U.S. Can pump a lot of oil. Saudi Arabia and OPEC can pump a lot of oil. So, should Iranian oil get disrupted, that may cause a short-term increase in oil prices, but the market can probably bear it, especially if we're still concerned that demand for oil isn't as strong as perhaps we'd like. But I think the bigger picture is just the overall world of volatility increasing. And I don't necessarily mean the VIX and the stock market volatility, but just there's a war going on in Eastern Europe. There's missiles being fired from Iran towards Israel. There's Israeli boots on the ground in Lebanon. Like as all these things start to happen, this sort of global peaceful world that we'd experienced post World War II or post Cold War, perhaps to be more specific, that allowed for global trade and prices going down and outsourcing, like that's coming to an end pretty abruptly. And it's unclear what the ramifications are, but they aren't positive for the global economic production.
Austin, what's your take on the Middle East?
Yeah, I think it's interesting. I think short term, as Adam referenced, there's likely to be a spike in oil prices, which that could have an impact on elections, given, a key topic in the elections right now happens to be inflation. And if we have higher oil prices, that's likely to reverse some of these declines in inflation. So that's obviously a political topic that, it's kind of a hot potato right now. Outside of that, I do believe, as Adam referenced, there's going to be a lot more volatility, but also we should look at nationalization of production for a number of products, because it's not just oil, it's goods that are produced in China. We don't want to be as reluctant in the US on foreign producers for the goods that people consume, and for that matter, even the ports, as we just touched on, right? And so we should look at reshoring as a key kind of theme in markets. And one of the aspects or one of the impacts of reshoring is likely to be inflation or higher prices, as we can't outsource some of the deflation that we've seen over the last 25 years. So it's a very kind of convoluted picture that, as investors, we need to not take one side, but kind of be diversified across multiple perspectives here.
Austin, I've got a follow up to that. Back in 2020 and 2021, there was a lot of national talk about reshoring a lot of critical manufacturing and non-critical manufacturing here in the US. Did we see any improvement in that over the last couple of years?
Yeah, there has been improvement, but it takes a long time. And it's they call it reshoring or nearshoring. So we have a lot more of our supply chain in some of our neighboring countries like Mexico and Canada. It isn't necessarily all coming back to the US, but think about it, it does take time to build a factory. And you look at what stimulus has been put into the government trying to draw manufacturers back to the country. It just takes time for all of this to kind of flow through. At the same time, we have countries that have been supplying us for years that are seeing significant headwinds because the world's consumer in the U.S. is consuming less of their goods. So we are seeing very much a push-pull. It isn't going to happen overnight. It will take time, but reshoring is definitely a trend that has legs.
CNBC is reporting that hedge funds are piling into Chinese equities like never before, as sweeping stimulus is sparking euphoria in the mainland. Adam, what do investors need to know?
Look, I think the key takeaway for me is just to remember how a government intervening in an economy, particularly an emerging market, a place like China, can have such a profound impact on equity prices. I mean, the Chinese stock market's up, I'm going to just ballpark it, 20% over the last, week, which is the entire year's return for the S&P in a week. So it reminds you that if you're short emerging markets or markets where the government isn't afraid to intervene, you can have your face ripped off quite quickly. If you're under invested or not invested, and it's part of your benchmark, you can find yourself chasing very quickly. And if you're just out there scouring the globe for value and you see value somewhere, sometimes when you're sitting and waiting for a few whiles, some time, you make all that return that you were looking for in a week.
Adam, as somebody with deep experience investing in international markets, is it too late now if you're not already in?
Look, I think I'd be more selective now than I would have a week ago. You could have bought sort of anything associated with China in any way and had a lovely week. I think now maybe be a little more selective about companies where you actually sort of like their business prospects. It's certainly not the same risk reward that it was a week or two ago. So I would be careful. I'd be cautious. I never want to say it's over because the Chinese market was so sort of beaten down and cheap and left for dead. That's one of the reasons it's had such a pop based on this news. It could also be that the government's not done. They've clearly told the world that they're going to stimulate, and if this first sort of instance of stimulus doesn't work, why won't they do more? They can. They have an appetite to do so. So I think a lot of people are playing catch up right now. And the last thing you want to be is you never want to be the last person to the party. But the party may still have some legs to it.
Austin, what's your take on what's going on in China?
It looks like the Chinese government stealing a page from the U.S. government and Jerome Powell, right? They're trying to pump up markets through pumping in both fiscal stimulus and monetary stimulus. And one thing I would say is expect the party to continue as long as the U.S. continues to stimulate, because China is likely to follow right along. Now, that stimulus doesn't overcome the disaster on the demographics front that was the one-child policy that's preventing their economy from growing, because they just don't have the population growth that one would expect for an emerging market. So there's a definite fundamental headwind, both from a demographics perspective, but also from working through all the excess liquidity that was pumped into the market over the last decade and a half. So there's kind of a push-pull, but I would say, given that China tries to peg their currency to the dollar, expect the Chinese government to stimulate as long as the U.S. government is stimulating, which will likely be a tailwind. And you're coming from a much lower valuation in China than you are in the U.S.
Guys, it's been a couple of episodes since we spoke about Nvidia. Its shares are up 150% year to date as of this recording. This week, their CEO said that demand for their next generation Blackwell AI chip is, quote, insane. Adam, how should investors look at and approach Nvidia today?
I would say apply an insane multiple to the stock and buy it until it gets there. No, look, if you've been following the story, and it doesn't feel like the AI story is over. It doesn't feel like the AI trade is over. Are there better risk reward opportunities than Nvidia today? Probably. But that stock has sort of become the bellwether for how the market is looking at the AI trade. And when a CEO comes out and says something that bullish and uses a word like insane to try to quantify demand, it's a pretty good, like, you'd expect the stock to be up. I mean, I wouldn't chase it here, but I also wouldn't have chased it 100% ago, and look where we are.
And Adam, are you using AI at all in your work?
Yeah, I'm actually not on the pod today. This is just an AI bot. Look, I like most people, I've played around with some of the AI engines, and it's been a fun little tool that hasn't been that useful to me personally yet. But I also expect it to continue to get better and better, and to become more and more embedded in a lot of our workflows. In some cases, where we don't even realize that it's AI that's doing what we're asking it to do. So, because the reality is, it's been around for a long time. We just haven't seen it. It's just become sort of more consumer facing. What I think could really fuel the next stage in AI is when it does get on, when the new software comes out for this new iPhone in the next month or so. If that proves to be helpful to people, then AI will become a big part of the conversation, even more so than it is now.
And do you think AI will have an impact in your comedy career?
Certainly not for good, I don't think. We'll have to see what it could do in terms of replacing people. But so far, when I've tried to use AI to write a joke, it's been terrible. So we'll see if it gets better.
All right. Well, Austin, what's your take on how investors should approach Nvidia today?
Anytime a CEO uses hyperbole like insane to define their business, it makes me kind of think twice. As the market adjusts to whatever the CEO's comments are, it leads to insane expectations on the stock. And that often creates a situation where companies have a hard time meeting those expectations. Now, I'll have to admit, over the last 12 months, that Nvidia has done a great job of exceeding expectations. Some of that has been around rhetoric on what future growth profiles could look like. I think the risk is to the downside, but that doesn't mean the stock can't keep going up.
Let's wrap up with our bull and bear segment. It's been a while since we've done one of these. Here are the rules. I'm going to throw the topic out, call out one of you, and you have 60 seconds to state your case, starting with whether you're a bull or a bear. Austin, the Mag 7.
I'm a bear on the Mag 7. It seems like they have insane expectations on their earnings with where market caps are, and it appears as though they're set up to miss those expectations in the years ahead.
Adam, Mag 7.
I'm also a bear on the Mag 7, and I would expect the other 493 companies in the S&P 500 to play catch up on a relative basis over the next 12 to 18 months.
Well, Adam, this is a layup then. U.S. equities, bull or bear?
I'm a bear on U.S. equities over the next 12 months. I think that we've got the stock market at highs, at all-time highs, with increasing geopolitical risk that is impossible to sort of quantify and understand. And when you're ripe for a pullback, and bombs are flying, missiles are flying in the Middle East, I'm gonna be a bear.
Austin, U.S. equities, bull or bear?
I'm a bull. I mean, Adam said it best when he said the 493 that are undervalued. So I don't think that we're going to see another kind of 20+% year, but I think that, we could see a positive year in the markets as, the real economy starts to catch up with some of these AI stocks that have seen enormous price appreciation over the last year and a half.
Bull or bear on U.S. oil prices? Austin.
In the near term, I'm a bull on U.S. oil prices. Intermediate term, I'm a bear. In the long term, I'm a bull.
Adam.
I couldn't follow what Austin said, but I'd say I'm a bear in the near term, or I'm a bear. I'll just say I'm a bear. I think I'm worried about the economy turning over and continuing to weaken and demand falling, and U.S. Oil production is just so robust. It's hard to imagine prices having a big upward move unless the geopolitical issues just continue to compound greater than I would expect them to.
Bull or bear on Chinese equities? Adam.
I'm a bull. I don't think this rally is over yet. I think hedge funds are piling in, and you know what comes after hedge funds? All the dumb money. So it's going to go for a while.
Austin, bull or bear on Chinese equities?
I'm a bull. I think the stimulus is just beginning, and they're going to continue to push asset prices higher until they get valuations that they want, which are more in line with the rest of the world.
Bull or bear on the broader emerging markets? Austin.
That's a good one. I'm a bull on the broader emerging markets, especially those that have fundamental and demographic tailwinds. I'm a bear on those that have demographic headwinds. I think that there are a number of attractive opportunities in emerging markets right now as currency markets have been in flux, which often creates opportunities in EM.
Adam, emerging markets, bull or bear?
I'm a bull on the emerging markets, and I think like China, there are some other emerging markets that have been sort of beaten down and left for dead. And we saw what happened in China, and not necessarily for the same reasons as China, but I think markets like Mexico and Brazil might get off the mat and show some life in the coming few years.
Bull or bear on Nike? Adam.
I'm a bear on Nike. I think the company's clearly been mismanaged for the past few years. A lot of upstart competitors have shown up, and I just do the test when I'm riding the New York subway and I look at people's shoes, and I see a lot of brands that I don't even know what they are, and I see less and less Jordans, and that's not good.
Austin, are you a bull or bear on Nike?
I'm a bull. I think they can turn things around. They might not keep market share where they like, but they do have a premium brand with pricing power. And I think as they continue to come out with new innovations, now they're not just focused on taking margin from distribution. I think they'll be in a position to actually to grow the brand and continue to deliver good returns for shareholders.
Excellent. Great show, gentlemen. Listeners and viewers, to learn more about Opal Capital, please visit opalinvest.com. And don't forget to subscribe on Spotify, Apple, YouTube, or wherever you get your podcasts.
The viewer of this content should not assume that any information presented or made available on or through this media channel is receipt of or substitute for personalized investment advice. Opal Capital LLC is an SEC-registered investment advisor. Registration with the SEC does not imply a certain level of skill or expertise. Opal provides its services exclusively to registered investment advisors, either through a sub-advisor relationship or a model provider consulting arrangement. For a copy of Opal's disclosure documents, please visit advisorinfo.sec.gov and follow the search instructions. Visit opalinvest.com or opaldividendsdigest.com to learn more.